Welcome to you both. So, Jason, what do you think this will likely shake out as it works its way through Congress?
Well, Kelly, I think ultimately it's not probably going to be the top rate at 43.4%. It'll probably be watered down because people will start to talk about what the optimal rate is for government revenues. I do think for this administration, I think as you were pointing out, there's an extra element of tax increases, an extra consideration, which is not just raising taxes to raise revenue to pay for government spending, but there's also a social justice angle to a lot of this stuff, which means that at the margin, they'll be, in my opinion, a little bit more willing to raise taxes. I think it's also important to note, though, that this would be coming in the context of increases in corporate income taxes and an increase in the top marginal income tax rate. It's very different than what it was in 1986, when you had an increase in capital gains taxes, but you had very significant reductions in the top marginal income tax rate and the tax rate on corporate profits. So this, I think as a whole, I think part of the reason why bond yields will stop going up and the dollar's been weakening, in my opinion, over the last month, is that people are starting to fear that this may sterilize some of the stimulus that's already been put in place.
And that's a really important point, because what you're suggesting is that the bond market says this actually will undermine some of the growth potential included in some of the other plans. Again, I know we're reading a lot into a few basis points, but that it's kind of moving in that direction. Mark, the really interesting thing about the muni market is that it's absolutely salivating at these prospects. So the worse the tax burden looks, the more that state and local governments and stadiums and all go, great, that means more and more investors will want to come finance our projects. And maybe that's how we end up getting an infrastructure bill passed unofficially.
I think that's right, Kelly, and welcome back. I think that the muni market hasn't seen this type of environment in quite a while. You're seeing a lot of tailwinds. You're seeing that the Fed and Treasury since last year has said they're going to have continued support for the space. Then you've got the fact that we're going to raise taxes, and that means more revenue. And then you've got an infrastructure bill in the $2 trillion range. That's primarily going to benefit states. And so there you have another added benefit there. And then finally, Treasury yields they should be insulated due to the yield spread and scarcity of munis. I'm trying to find good municipal bonds for clients now. Very difficult, but that tells me there's a lot of upside in the municipal bond market. And so we're telling our clients preemptively to start considering buying munis in the state that you're in, always keeping it in mind that you got to look for, AAA, AA munis.
But Mark, do you see my point, though? It's kind of ironic that at the same time we're debating an infrastructure bill, if we go ahead with these tax increases, you could get this huge possible infrastructure boon anyway, because money will be pouring into the municipal bond space. I mean, it kind of would work to unofficially achieve some of those same goals, albeit in a really roundabout way.
Right, but I don't think that this is just I think this is the beginning of higher taxes. I don't think this is the end. So if you are in that camp that taxes can just go higher, historically, they're really low. In 1944, top marginal rate was like 90%. We've got a lot of possible rates to go, especially if you see out of Washington that there's an appetite to continue to tax millionaires. And so as long as that's the case, I would say that munis are a great place to be in this environment.
All right.
Shepard Smith here. Thanks for watching CNBC on YouTube.